Imagine you have exactly $1,000 in your hands today. You worked hard for it, you saved it, and you decide to put it in a safe place, maybe under your mattress or hidden in a drawer, thinking it's perfectly secure. $100 just evaporated into thin air. You didn't spend it, you didn't lose it, nobody robbed your house, yet your money was stolen by an invisible thief. That thief is called inflation. If you leave your cash sitting idle, you are mathematically guaranteed to lose wealth over time. Today, we are going to expose exactly how this happens, and more importantly, how you can build an unbreakable financial shield. Welcome back to Jimmy Finance Advise. If you want to stop losing money to the system and start building real generational wealth, you are in the right place. Most of us were taught a very traditional financial rule growing up. Work hard, earn a salary, and save your money in the bank. But in today's economic climate, saving fiat currency is actually the riskiest thing you can do. Today, we are going to talk about why your cash is losing value and the 4 major lifeboats you need to jump into: real estate, gold, stocks, and crypto. If you get value out of this video, make sure to hit that like button and subscribe. Let's dive in. So, why did your $1,000 turn into $900 in purchasing power? It all comes down to supply and demand. Governments and central banks control the supply of fiat currency, like the dollar, the euro, or the baht. When governments need to stimulate the economy or pay off debts, they print more money. But here is the catch. They aren't creating more value, they are just creating more paper. When the supply of money goes up, the value of each individual dollar goes down. This means it takes more dollars to buy the exact same goods. Think about the price of a cup of coffee, a gallon of gas, or a house 10 years ago compared to today. The coffee didn't become inherently more valuable. The currency you used to buy it simply became weaker. Inflation is essentially a hidden tax on your savings. When inflation runs at 5%, 8%, or 10% a year, keeping your money in a bank account that pays you a 1% interest rate means you are experiencing a negative return. You are slowly bleeding wealth. So what is the solution? You have to move your wealth out of paper currency and into assets. An asset is something that puts money in your pocket or holds its value over time, regardless of what the government does with the money printer. Let's look at the first 2 historical safe havens: real estate and gold. First, real estate. Land and property are finite. They can't just print more land. Because of this scarcity, as the currency devalues, the price of real estate naturally goes up. Not only does real estate act as a powerful hedge against inflation, but it also provides a dual benefit: cash flow. If you own a rental property, you can generate monthly income while the underlying asset appreciates in value. Next, we have gold. For thousands of years, across empires and modern nations, gold has been the ultimate store of value. Why? Because it is difficult to mine, its supply grows very slowly, and it has universal trust. Gold isn't necessarily meant to make you incredibly rich overnight. Instead, it is an insurance policy. It protects the wealth you have already built from evaporating. While gold protects your wealth, stocks are how you aggressively grow it. When you buy a stock, you aren't just buying a ticker symbol on a screen. You are buying a fractional ownership piece of a real, breathing business. Great companies, the ones producing the goods, services, and technology we use every day, are able to adapt to inflation. If inflation pushes the cost of raw materials up, what do these companies do? They raise the prices of their products. This means their revenue goes up, and ultimately, their stock price goes up to match the inflated economy. You don't even need to be an expert stock picker. By investing in broad market index funds, like the S&P 500, you are betting on the overall growth of the economy. Historically, the stock market has returned an average of 7 to 10% per year, easily outpacing standard inflation and protecting your purchasing power. Finally, we come to the newest, most disruptive asset class of our generation: cryptocurrency. While traditional assets are great, the financial system is evolving. In a world where central banks can manipulate fiat currencies at will, decentralized digital assets offer a mathematical alternative. Let's look at Bitcoin. Bitcoin is often called digital gold because of its tokenomics. It has a hard-coded maximum supply of exactly 21 million coins. No government, no CEO, and no central bank can ever print more. In an environment where fiat currencies are being inflated away, an asset with absolute, undeniable scarcity becomes incredibly valuable. But it goes beyond just Bitcoin. The broader crypto ecosystem, including Layer 1 blockchains and decentralized finance protocols, represents the future infrastructure of money. While crypto is undoubtedly more volatile than real estate or gold, it offers the highest potential upside for those willing to do their research and understand the underlying technology. It is a vital component of a modern, inflation-resistant portfolio.
So let's go back to that $1,000. If you leave it in a drawer, it becomes $900. But if you deploy that capital If you buy a fraction of real estate, if you accumulate gold, if you invest in strong companies, or if you hold decentralized crypto assets, you aren't just protecting that money. You are putting it to work. You are turning your cash into an army of soldiers that work for you 24/7. Money is a tool. Don't let it sit idle and rust. Cultivating a growth mindset means taking control of your financial destiny. Do your own research, diversify your portfolio, and start protecting your purchasing power today. If you found this video helpful, please subscribe to the channel. Leave a comment below about which asset class you are currently investing in, and share this with someone who needs to hear it. I'll see you in the next video.